Welcome, dear traders. After yesterday's interest rate decision by the US Federal Reserve, stock market started to cool down. As a result, stocks in the Asia-Pacific region followed Wall Street and opened Thursday's trading session in the red. Oil prices continued to fall today, and yesterday's session saw the biggest drop in months. Let's have a look at other factors that influenced Thursday's trade. It's me, Kate Stichina, and you're watching a recap of the Asian session on September 21. The US Federal Reserve left its key interest rate unchanged after its two-day meeting, and this decision did not catch markets off guard, as 99% of the market was expecting a pause from the US regulator. So, why was the reaction to this decision so strong? The Fed comments contained two hawkish statements. First, the central bank's interest rate projections for 2024 were slightly higher than expected. Even if inflation slows down, the regulator's hawkish policy will unlikely change. Second, policymakers believe that the US economy will continue to expand even if rates are raised further and for longer. The Fed's dot plot points to another hike in November or December. Moreover, the number of possible cuts in 2024 has been reduced to 2. At the meeting in June, four such cuts were predicted, and the US dollar received a strong hawkish signal from the US regulator yesterday. The Fed is likely to keep the rates higher for longer, supporting the US currency. As a result, the greenback jumped to 105.20 yesterday. After that, it rose to its highest level of 107.50 since early March. In Asian trade, the US dollar index increased within the range of 105.40 and 105.70. The yield of US Treasuries also supported the growth of the greenback. In addition, two-year Treasuries posted 17-year highs. Long-term 10-year US government bonds climbed to the highest levels since 2007 this morning. The yield on the 10-year Japanese government bond has risen to its highest level in more than a decade. The Japanese yen, which depends on the interest rate differential, strengthened today, slowing the gains it made against the US dollar yesterday. On Thursday, the dollar-yen pair was consolidating within the range of 148.10 and 148.50. After testing the 10-month high of 148.47, the price fell slightly to 148.30. Although the pair traded mostly in a bearish territory during the Asian session, technical indicators are still pointing to bullish momentum supporting the uptrend on the chart. However, the Bank of Japan is unlikely to make a hawkish reversal this Friday, even if the dollar-yen exchange rate rises to levels seen at the end of last year. Meanwhile, Japan is ready to use its US dollar reserves to intervene in the foreign exchange market and extinguish the overheated depreciation of the yen. And today, Chief Cabinet Secretary Hirokazu Matsuno said that the authorities would not rule out any options in addressing excess volatility in the currency markets. On the other hand, if the yen's movement excludes sharp volatility, monetary policymakers may not intervene at all. At the same time, the regulator may continue to use verbal interventions. In such an economic environment, the antipodium currencies are losing ground. Oil prices failed to support the Australian dollar. As a result, the currency continued to decline in the Asian trade today. The Aussie, which is sensitive to risk sentiment, also came under pressure from peers and went down to 0.6413. Early Thursday, the Aussies decline within the daily range of a 0.6402 and 0.6455, wiped out almost all of the last week's gains. The New Zealand dollar received some support from stronger GDP data, but it was not enough to prevent the Kiwi from falling. Early Thursday, the New Zealand currency was trading in the red within the range of a 0.5900 and 0.5951. The Kiwi closed the Asian session with a Fed figures just below 0.5920. In addition, China, the main trading partner of most countries in the Asia-Pacific region, is still raising concerns about the economic slowdown and the decline in demand. It appears that the region's currencies are completely dependent on the greenback. For example, the rupee steeply declined to 83.2 yesterday after the US dollar surged sharply overnight. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. See you online soon.